Welcome back everyone to the second part of the lecture. Now we have completed chapter number 6 and we have learned what are the required tools to build a good financial planning, whether for the long run or the short run for a new venture. Let's try to put into practice all these theoretical concepts that we have seen until now. So I propose to move to the exercise sections of this chapter. And I propose the exercise number 9. I choose this exercise because I think it's one of the best ones proposed by the textbook. It summarizes actually almost the most interesting concepts that we have seen until now. So let's not waste more time and go and let's go to the exercise number 9. Okay. Exercise number 9, page 226. So as you can see here, the exercise is about the short-term financial planning. The good thing with this one is that it will summarize all that we have seen regarding the financial planning of the income statement, the balance sheet, the cash flow statement, as well as the cash budget. So Artero Corporation is a traditional toy products retailer that recently started an internet-based subsidiary that sells toys online. A markup is added on goods the company purchases from manufacturers for resale. Sven Artero, the company president, is preparing for a meeting with Jennifer Brown, a loan officer with First Bank Corporation, to review year-end financing requirements. After discussions with the company's marketing manager, Rolf Eriksson, and finance manager, Lisa Erdinger, sales over the last 3 months of 2011 are forecasted to be as follows. So these numbers are the forecast for the sales of the next 3 months, right? Which means that we are actually at the end of the month of September, and we are forecasting the sales for the last quarter of the year. Artero's balance sheet as of the end of September 2011 was as follows. So we have the numbers. Now, all sales are made on credit terms of net 30 days and are collected the following month, which means that every time you are selling during the current month, we will receive the payments the next month, right? So the accounts receivable here represents the sales of the month, or all the sales of the month of September that will be received on October. And the sales for October will be recorded as accounts receivable, and then they will be received during the month of November, and so on. Then the inventory on hand represents minimum operating level or safety stock, which the company intends to maintain. So we will remove this sentence, right? So no need to keep this one. Cost of goods sold averages 80% of sales. Inventory is purchased in the month of sale and paid for in cash. And then we'll modify this information, and we'll assume that the inventory is purchased 1 month earlier, which means that we will purchase the necessary raw materials or necessary goods. For example, for the month of November, we'll purchase them during the month of October, right? So we'll make the purchase 1 month earlier. Now, other cash expenses average 7% of sales. Depreciation is $10,000 per month. Now, assumed taxes are paid monthly, and the effective income tax rate is 40% for planning purposes. Now, the annual interest rate on outstanding long-term debt and bank loans, notes payable here. So these two, rubrics, notes payable and long-term debt. So we will apply, or the bank will apply 20% of annual interest rate. Now, there are no capital expenditures planned during the period, and no dividends will be paid. The company's desired end-of-month cash balance is $80,000. The president hopes to meet any cash shortages during the period by increasing the firm's notes payable to the bank. The interest rate on new loans will be 12%. So this is the same interest rate applied for the existing debt. Now, this is, I think, the most critical information for the exercise, because see, the company's president is fixing a goal that by the end of each month the cash available should be equal to $80,000. Now, for some cases, we might or the companies might not have the necessary the necessary generated cash flows to meet this goal, right? In such case, the company will ask the bank to get to have another extra credit in order to have or to achieve the necessary 80,000 cash by the end of each month. Now the tasks are: first, the monthly pro forma income statements for the next 3 months, then the monthly pro forma balance sheets, then the monthly cash budget, and the monthly statements of cash flow. Then finally, describe your findings and indicate the maximum amount of bank borrowing that is needed. So let's move to Excel. See, so we have the pro forma income statement, the pro forma balance sheet, and the inventories schedules. So you will see that we will need these inventory schedules in order to to fill the inventories rubrics for the pro forma balance sheet. So let's start by the pro forma income statement. So we'll start by the actual or the current month, September. Now the sales, as I told you, so we don't have the sales for September, but we can find them using the accounts receivable. Remember that all the sales for a given month will be delayed, or the receipt of the sales of current month will be delayed for the next month. So the sales of September will be recorded as accounts receivable. Right? So 700 is the amount of sales for the month of September. So 700. Now the cost of goods sold represent 80% of the sales. So 80% of the sales. Now the profit margin is the sales minus the cost of goods sold. Now the other expenses represent 7% of the sales. Now depreciation, let me just check. Depreciation is $10,000 per month. See, so since all the numbers are recorded in $1,000, so depreciation will be equal to 10. Now the EBIT, earnings before interest and taxes, is equal to profit margin minus the other expenses minus depreciation. Now the interest for September, we will not face problems, because for September we already know how much how much debt we are contracting. So we are contracting 800 plus 400, which means 1,200. Now the interest rate, so you have to pay attention here, that you have to use is not 12%, because this is the annual interest rate, while here we are trying to find or to compute the monthly net income. So we cannot use an annual rate for a monthly net income. So we have to convert this annual interest rate into monthly interest rate. So if per 1 year we are paying 12% as interest, this means that for 1 month we will pay 1%, right? So equal to 1%, which is the monthly interest rate, times the total of the debt, which is 800 plus 400. 800 plus 400. So 12. Now the earnings before taxes is equal to the EBIT minus the interest. Now the taxes represents 40% of the EBT, so equal 40% times the EBT. Then finally we can have, or we can find the net income is equal to the EBT minus the taxes. So this is the net income for September, right? Now we should, follow the same process for the following, months. So for October, so 1,000. November 1,500, December 3,000. Now for January, the projected sales for January are not given, so I will, but they are 700. So just please add this information, 700, right? Now the cost of goods sold is equal to, as I told you, see 80% of the sales. So no need to repeat this function, this formula, a lot of times. So all you have to do is to click on the corner of the cell and to scroll on the right hand side, and it will compute automatically the cost of goods sold. Same thing for the profit margin, the other expenses, since all these numbers are a function of the sales. Now depreciation shall remain constant, the EBIT. Now the interest here, so this is the key problem of this exercise. So the interest will be paid on the basis of the total debt contracted by the firm. Now for the month of October, November and December, we do not know how much the firm will, or if the firm will need extra debt or not. So it depends on the cash available by the end of each month. If the firm will generate enough cash to achieve this goal of $20,000, so no need to go to the bank and ask for a new debt. Now, if the cash generated by the firm is insufficient to achieve this goal, the firm will have to go to the bank and ask for an extra or a new debt, right? So we, at the moment, right now, we cannot, know how much the debt will be for the next months, and so and therefore we cannot compute the interest. So we'll keep this, this part of the table. I will postpone it right after, right? So same thing, we cannot compute the EBT, nor the taxes, or the net income. Now, as I told you, so the key thing is to compute the interest. Once we will succeed to find the interest, we can compute, the EBT, taxes, and net income for each month, right? Now, the interest are function or depends on the total of the debt of the firm, right? So it depends on the notes payable and long-term debt here, right? So this is the pro forma balance sheet. So I already, built the pro forma, and I already, put the numbers here related to September because they are already given in the exercise, right? Now, since the firm is likely to obtain or to ask for new debt, I will add or insert a new row, and I call it extra notes payable. So this is the eventual debt that the firm might ask for if the firm is, or cannot generate enough cash to have $80,000 of cash by the end of each month, right? Now we have to complete the missing cells. So for the cash, so the firm must have $80,000 by the end of each month. So this is the requirement made by the boss of the company. Now for the accounts receivable, as I told you, it will be equal to the sales of each month. So equal to the sales of each month. since all the sales are made on credit and will be, received the month later. So now for the inventories, we need to build what we call a schedule or inventory schedule, right? So it's inventory schedules. So we have to, for each month, we have to find the beginning inventories, then plus how much we have purchased of goods or raw materials, minus how much we have consumed of these raw materials or goods, and then we can find the ending inventories, which is the beginning plus the purchases minus the cost of goods sold. Now for September, we already have the ending inventories, which is given to us. For October, so see, now the ending inventories for each month will be the beginning inventories for the next month. So for October, it will be equal to ending inventories for the next month. Now the purchases, as I told you, the firm will purchase the required raw materials or goods 1 month earlier, which means that we'll purchase the cost of goods sold. For October, we'll purchase the cost of goods sold of November 1 month earlier. So equal the cost of goods sold of November. Now minus the cost of goods sold, see, of the current month of October, which means, so equal the cost of goods sold of October. And then we should find the ending inventories, which is the beginning inventories plus the purchases minus the cost of goods sold of the current month. Now same thing here, the ending inventories of October will be the opening inventories for November. Now the purchases, it will be equal to the purchase of December. The cost of goods sold of the current month. And this is now the purchases of this so January, see, Let me check the results. Okay, so here we are. So we have made a mistake here because minus cost of goods sold, it is equal to 800, not 1000. Sorry. That's it. So these are the ending inventories. All you have to do is just to copy these numbers and paste them into the balance sheet. So 900 here, 2100 for November, and 260 for December, right? Now for the next fixed assets, as we have depreciation of $10,000, this means that the net fixed assets should decrease by 10,000 monthly. So equal to this minus and it will continue to decrease by the same amount. Now total assets, so we have to sum these 4 cells that's it. Now the accounts payable should remain 0 because we are purchasing all our raw materials or our goods in cash. Now the notes payable should remain the same. Same thing for the long-term debt. So now the total liabilities, so it is the sum of the accounts payable, notes payable, the eventual extra notes payable, and the long-term debt. Now the equity, so we cannot compute the equity for October, November, December until we have computed the net income, because see, remember that for the earnings of the monthly earnings of the firm, we have assumed that all the net income will be retained, and so it will be added to the equity. So the equity of October will be the equity of September plus the net income of October, and we cannot find this net income for October until we have found, see, the interest and so on. Equity, we need the net income, all right? And to compute the net income, we need to fill these missing cells, which are the interest. And to find the interest, we need to know how much is the total of our debt, which means that we need to know if the firm will need an extra notes payable or not. So see, so this is the biggest challenge of this exercise. We are in interrelated variables, right? Each one of them is required to compute the other ones. I repeat, in order to find the equity or the new equity value for each month, we need to know how much the firm will earn, because the retained earnings will be added to the equity. And to find how much the firm will have as net income by the end of each month, we need to know how much interest shall it pay. And to know how much interest will be paid by the end of each month, we need to know what is the total amount of debt by the end of each month. And to know how much is the total debt of each month, we need to know if the firm will contract a new extra notes payable from the bank or not. So this is the biggest challenge of the exercise, and the key point is this variable. So this is the key point. If we find the right value of the extra notes payable, we can easily know how much is the total debt. And if we know how much is the total debt, we can find how much is the interest. Then we can know how much is the net income. And finally, we can add this net income to the equity, and we can find how much is the new equity value. So this is the yellow row is critical to find or to resolve this exercise. So let's see now how we can find the extra notes payable for each of the 3 following months. Okay, so remember that I told you the most critical variable that we have to identify is the amount of the new notes payable, right? So these new notes payable should meet some conditions. The first condition is that the sum of the total liabilities plus the sum of the equity should be equal to the sum of total assets, right? So let's try to do it for the month of October, right? For October, we have the total assets equal to, I think, let me check, 2,720. Now, the total assets must be equal to the total liabilities and the equity, right? So this one had to be equal to total liabilities and equity. Now for total liabilities, we have 4 components. We have the accounts payable, we have the existing notes payable, we have the new notes payable, the variable that we are looking to compute, and we have the long-term debt, right? Since the firm does not use the accounts payable because the firm is purchasing is making all its purchases by cash payments. So the total liabilities will be composed by three components: the existing or the old notes payable, the existing long-term debt, and the eventual new, notes payable. And for the equity, we have the existing equity plus the net income for each month. So for the total liabilities, we can identify three components. See, we are talking about, don't forget, we are talking about the month of October, right? So for total liabilities, we have the notes payable, 800. We have the long-term debt, 400. And we have the extra notes, payable, this is the unknown variable, the X, right? Now, while for the equity, we have two components. We have the existing or the equity for the previous month, for September, and we have the net income of October, right? The net income of October itself is, conditioned by the X. So once we have found the X, we can easily resolve the exercise. So these are the conditions that we have to meet in order to find the X. The sum of the total liabilities with the equity should be equal to 2,720. So let's rewrite this formula. So we have 800 plus 400 plus X, these are total liabilities, plus 800, which is the equity of September, 800, plus the net income of October. All these should be or must be equal to 2,720. Now, see, we have two unknown variables. We have the X and we have the net income, right? And we cannot solve or resolve one equation with two unknown variables. So we should have just one unknown variable. So the solution is to rewrite the net income using the X. So I'll show you how we can do it. Remember that the net income formula, the net income for October is equal to the EBIT minus the interest minus the taxes, right? So we already know the EBIT. So the EBIT for October, let me check, is equal to 120. Now the interest are equal to 1%, which is the monthly interest rate, times total debt. So this total debt, see this one, is this one. Total liabilities, 800 plus 400 plus X. So we can replace total debt by this new, or this new formula. So equal 1% times 800 plus 400. So 1,200 plus X. So these are the interest. Now the taxes represent 40% of the earnings before taxes, right? So we can once again rewrite the net income formula as follows. So the net income of October is equal to the earnings before taxes, which is the EBIT minus the interest. So these two will give us the EBT, the earnings before taxes, minus the taxes. Or we can write it once again as 1 minus the corporate taxes times the earnings before taxes. So since the corporate taxes for this example is 40%, so 1 minus 40% is equal to 60%. So the net income is 60% times the earnings before taxes. So we are getting closer to our results. Now we have to rewrite the EBT using the X. I'll show you how. So you need just to to focus, because this is the most critical part of the example. See, every step is leading us to another step, so we have to to keep our concentration, right? You have to focus on on how we are moving from one step to another step. So the net income of October, see, is equal to 60% for the earnings before taxes. Now the earnings before taxes is equal to the EBIT, earnings before interest and taxes, minus the interest, and the interest are equal to 1% times, see, 1,200 plus X. So now we have succeeded to rewrite the net income formula using the X. Now we can resolve the equation, because we have just now we have one unknown variable, which is the X. So remember our first equation is as follows: is total liabilities plus equity equal to total assets. So 800 plus 400 plus X, these are total liabilities. These are, see, total liabilities, plus the equity, which is the existing equity plus the net income. So this is the net income plus 60%. We already know the EBIT, right? It's 120. So the EBIT minus 1% plus X. Sorry, I don't have enough space, So this one is equal to 1,200 plus X plus 800 plus, now the EBIT, check once again, is 120. So plus 800 here. So these are total liability. No, sorry. Plus 800 plus 60%. Now the EBIT, see, is equal to 120 minus 1% times 1,200 minus 1% times X. So equal, now this one plus this one plus this one is equal to 2000 plus x. See, so every time I'm using a number surrounded with red color. Now 60% times 120 it is equal to 72. I'm using this number. Now 60% times 1% times 1200 is equal to minus 7.2. Alright, and now 60% times 1 minus 1 times 1% times x is equal to minus 0.006x. So this means that I will put the numbers all together and the x on the other side. So 2000 plus 72 minus 7.2, right, plus x minus 0.006 x, right, equal to 2712. So let me just compute. So 2000 plus 72 minus 7.2 2074.8, right, and x minus 0.006x is equal to 0.994x, which means that the x is equal to 2720 minus 2074.8 divided by 0.994. Equal to 659.15. So this means that the firm has to contract a new debt from the bank equal to 659.15 in order to reach its goal of a cash equal to $80,000 by the end of the month of October. This new debt will affect the total debt, which in turn will affect the interest that the firm will have to pay, which in turn will affect the net income, and finally it will affect the equity of the firm by the end of the month. See, so the key point is the x. Once we have found the x, we can easily find the interest to pay. We can easily find the net income of the month, and then we can easily compute the new equity of the firm. So this is the new debt that the firm has to ask the bank for during the month of October. Now, the good thing with such exercise, I have to confess, these are difficult ones, right? But the good thing that by the end of the exercise, you will be sure if you are, giving the right answer or the wrong answer. If this, X was the right answer, you must have, an equilibrium between total assets of the firm and total liabilities and equity of the firm on the other hand, right? So let's check, if this X is the right answer or not. So let's go back to the Excel sheet. So here we are once again. remember that we have found that the new or the extra notes payable should be equal to 659 point, sorry, point 15, right? Now, which means that the new interest for the month of October are equal to 1% times the total of the new debt, which is the existing short debt 800 plus the new debt plus the long-term debt. So this is the new, interest, 18.5915, right? Now the EBIT, the EBT, which is the earnings before taxes, is equal to the EBIT minus the interest, right? Now we should subtract taxes, 40% of taxes. And finally, we can get the net income for October. Now this net income will be totally retained and added to the equity. So the new equity for October is equal to the existing equity of September plus the new net income. Now if we are doing the right thing, we should have here total equal to total assets. So equal, so the sum of the total liabilities and the equity. Now say we can round up this number and as you can see here we have the equilibrium between total assets and total equity and liabilities, which means that we have brought the right answer, right? And we should redo the same things for for the following months. So I'll give you, and also in order to save time, I will give you the right values of X. So just check my answers. So for the month of November, the X will be equal to, sorry, this one, 2,258.95, and for December 1,698.29. So anyway, I will give the detailed solution for the extra notes payable for the November and December with in this Excel file, right? Now same thing here, we should calculate the new interest. It is 1% times the new total debt 800 plus the extra notes payable plus the long-term debt. Same thing for December, 1% times total debt and have the earnings before taxes. Then you have the taxes, and finally the net income. And then you have to add this net income to the existing equity. And finally, we should check. See, we have for each one of these two, have the same number. Sorry for this one. Seems like as if we had make a mistake. Let me check just please. Sorry, the mistake here is that, okay, so for the purchase for the month of December, see here, we should consider the cost of goods sold, right, not the sales of January. So it is 560, right? Sorry, so this one, so it should be equal to the cost of goods sold, right, which means that the ending inventories is 260, 260, that's it. See, so now we have, see, even if we are committing mistakes, we can identify them because we have to find an equilibrium between the total assets and the total equity and liabilities. So see, we have this equilibrium for each of these 3 next months, October, November, and December. So this means that we are doing good until now, right? So this is this is all for the pro forma income statement, the pro forma balance sheet, right? And for for the projected or for the projections for the months of October, November, and December. Okay, so I will put the details of how we have found the extra notes payable for November, December. We'll find them in this new sheet. I will name it details X, right? And I will save the workbook. I will call it Altero Corporations. And I will send you, sorry, inshallah, this Excel file, right? Okay, girls, that's all for today. I will send you the Excel file, and I will upload these lectures on YouTube. I'll send you as well, the YouTube link also. I will ask you to complete the exercise, complete the pro forma cash flow statement and the cash budget, right, for the months of October, November, and December, and then send back the Excel file to me via email. This would be your next assignment, and you have to complete it and send it by email before the next lectures. That's it. I hope you have enjoyed the lectures, and please feel free to contact me should you have any questions or should you need any clarifications. So keep safe and see you next lecture, inshallah. Bye bye.